Hey everyone, welcome back to Corporate Dakota, where we try to understand what these giant companies are really up to. Tonight, we're re-diving into Blackwell 3D Construction Corp. S latest 10Q filing. You ready to take a peek behind the corporate curtain? And hey, if you like getting the real scoop on these filings, make sure you are subscribed. We also have a Discord community link down below, so come hang out and talk numbers with us. Alright, so this is a quarterly report a company sends to the Securities and Exchange Commission. Or SEC, it gives us a snapshot of how they're redoing financially over the last few months. Blackwell 3D Construction Corp is telling us how they performed up to the 31st of August of 2025. When we look at their balance sheets, which is basically a snapshot of what the company owns and owes, we see some pretty small numbers here. For the 31st of August 2025, their total assets were just $1,609. That is less than what most people spend on a decent vacation. And at the same time, their total liabilities, meaning what they owe, were a whopping $903,276. Yikes. This leads to what they call a stockholders deficit. Instead of having money, there is a negative balance, meaning if they sold everything they own, they still would be able to pay off their debts. For the 31st of August 2025, this deficit was over $900,000. That is a massive hole to climb out of. Now, let's look at how they performed over a specific period. For the 3 months ending the 31st of August 2025, they reported a net loss of $41,822. This is a pretty small loss compared to the previous year, where they had a massive loss of $873,210 for the same period. So, an improvement, sure, but they're still losing money. Interestingly, under revenues, they've got a big fat zero for both periods. That means they didn't actually earn any money from selling products or services in these recent quarters. That is a pretty big red flag for any business. Where did the expenses go then? For the 3 months ending the 31st of August 2025, they spent $16,073 on general and administration. That is much lower than the $62,785 they spent in the same period the year before. But the biggest dip in expenses comes from professional fees. In 2024, they spent a staggering $808,368. In 2025, that number dropped to just $14,080. This significant drop tells us something important. The previous year, S-High professional fees were likely related to some major corporate action or restructuring. The fact that it is so much lower now suggests that most of that work is done. Because their revenues are zero, their entire operational expenses translate directly into a loss from operations. For the 3 months ending the 31st of August 2025, that operational loss was $30,153. Again, a huge improvement from the $871,153 loss in 2024. This improvement is directly tied to those lower professional fees. They also have interest expenses, which is the cost of borrowing money. In 2025, they paid $12,716 in interest compared to only $2,907 in 2024. This increase in interest expense means they likely took on more debt, or the terms of their existing debt became more expensive. When we look at earnings per S-Hair or EPs, it is also showing a loss. For the 31st of August 2025, the loss per S-Hair is essentially $0. This is after a 1-for-250 reverse stock split, which makes the numbers look a bit different. The previous year, the loss per S-Hair was $0.01. This means for every share of stock you own, you are losing a penny. It is not a lot, but it is still a loss. And speaking of shares, notice how the weighted average number of common shares outstanding is over 60 million for both periods. This is after a significant reverse stock split. This suggests a lot of shares are out there, and as we've seen, they're not generating positive returns. Let's check out those promissory notes again. These are essentially loans for the 31st of August 2025. The total short-term promissory notes payable are listed as $520,465. This is a pretty significant amount for a company with such tiny overall assets and no revenue. Some of these notes are due on demand, meaning the lenders can ask for their money back at any time. That creates a lot of uncertainty. For example, a note dated the 21st of July 2025 for $7,000 is only due on demand. This kind of short-term demand-based debt is a big risk. If too many lenders suddenly want their money back, the company could be in serious trouble. Now, there is this line item called stock payable. As of the 31st of August 2025, it is $1,650,000. This sounds a bit unusual. It usually means the company owes stock to someone, perhaps for services rendered or as part of a deal. Given the company is struggling and has no revenue, it's worth paying attention to how this stock is valued and why it is owed. And finally, we have the accumulated deficit. This is the running total of all the company S net losses since it started. As of the 31st of August 2025, this deficit is a massive $12,212,804. That is a lot of red ink over the years. In the management's discussion and analysis section, the company itself talks about its financial health. They admit they have virtually no revenue and a significant accumulated deficit. They're also very clear about their dependence on future funding, stating they are entirely dependent on their ability to attract and receive additional funding from either the sale of securities or outside sources. They admit there are no firm agreements for this funding, and there is no guarantee they'll get it. This is a clear warning sign. They also mention the going concern issue. This is a standard phrase in financial reports where management has to assess if the company can continue to operate for the next year. They acknowledge that their net losses, accumulated deficits, and use of cash in operations raise substantial doubt about their ability to keep going. They believe they might be able to continue operations in the future, but it hinges entirely on getting more money. This sentence is critical. It tells us that their entire operation, including paying for expenses like professional fees and interest, has been funded by selling more stock or borrowing money. They aren't making money from their core business. They also discuss their internal controls. They admit that their internal controls over financial reporting are not effective. They cite limited internal resources and a lack of ability to have multiple levels of transaction review. This means that mistakes or even fraud might not be caught in a timely manner. They mention a material weakness due to a lack of segregation of duties because of limited personnel. This is a serious issue. They go on to list specific weaknesses: insufficient experienced personnel, lack of optimal segregation of duties, and no audit committee or independent financial expert. They plan to address these issues once they have sufficient capital and operations. But right now, there is a real risk of errors in their financial reporting. Finally, we look at the exhibits. These are supporting documents. We see certifications from their principal executive officer and principal financial officer, basically saying they swear the financial statements are true to the best of their knowledge. We also see a lot of technical documents related to XBRL, which is a way to tag financial data electronically. So what is the story here? Blackwell 3D Construction Corp is in a very precarious financial position. They have virtually no revenue, significant accumulated losses, and substantial debt that can be called at any time. Their financial statements themselves point to a material weakness in internal controls, meaning potential errors could go unnoticed. Their entire existence seems to depend on external funding with no guarantees of receiving it. While they very reduced expenses and losses compared to the prior year, this is largely due to finishing up major professional service engagements. It does signal a fundamental improvement in their ability to generate income. The company is essentially living on borrowed time and borrowed money, with no clear path to profitability based on the information provided. The lack of revenue and the dependence on financing are major red flags. The material weakness in internal controls adds another layer of risk, making it harder to trust even the numbers they do report. Looking at the big picture, this company is a high-risk proposition. Their direction seems to be focused on survival through external financing rather than building a sustainable business. The primary opportunity appears to be attracting new investors willing to take on that risk. The biggest risk remains their inability to secure funding, which could lead to them becoming dormant or ceasing operations. Alright, that is our breakdown of Blackwell 3D Construction Corp. S latest filing. What is your take on these numbers and what they signal for the company? S future. Do you see any hidden gems or are you seeing the writing on the wall? Drop your thoughts in the comments below. If this analysis was valuable, hit that like button and subscribe for more deep dives into the corporate world. And don't forget to check out the Discord link in the description to continue the conversation. Thanks for watching. See you next time.